I'm hopefully going to give you a slightly different perspective, and I'm really not going to be talking about money market funds. I'm going to be talking about business and what business actually needs. But you will see the connection, I hope. The European Association, which John mentioned, we're active members of, and what we want is a stable financial sector which really supports the essential service requirements of the real economy. Corporate treasurers on a day-to-day basis don't really worry too much about financial assets, cash. It's an incidentally small part of their business. They actually invest in real assets and intangible assets. That's where they take their risk. So they actually take risk all the time. You pay your money, you take your choice in terms of what proportion financial assets or cash actually represents for corporates. But it could be 5, 10%. It's larger in the larger companies. Globally, the top 2,000 companies, if you strip out banks and financial institutions, have $3 trillion worth of cash. Now that sounds like a lot of money, but when I tell you they actually owe $12 trillion worth of debt that they have to pay back, and you just merely paid it back, you'd be saying, actually, truly, they owe $9 trillion. There's an awful lot of perspective on cash and money market funds. So why is it there? Treasurers actually only worry about a couple of things. They want to make sure that when they place their money that they've worked hard to generate, they can get it back. So security is the first important thing. Second aspect is liquidity. It's there when you need it. And only finally do we ever get round to talking about the yield. That has always been the case, and that's what professional treasurers worry about. So we see business as all about how you actually can get the confidence to actually grow the economy and to get the investments going. So I suppose our challenge on the debate around money market funds, and it's a very interesting one, is I'm going to put back onto the panel, and if Nina, if she was here, where do you think this money is going to go if we start giving rise to uncertainty for non-financial corporates, that they can't get their money back when they need it? And why is that important? Well, you also have to ask, is financial stability going to be enhanced as a result of that, or will it be diminished? Is there going to be greater uncertainty? Is the whole debate about money market funds a business confidence enhancing exercise for us? And I think the answer that we have as professional treasurers is no, very firmly. This event is QED, and I'm very happy to be here, but the phrase means what was to be demonstrated. So I think the challenge for corporates when asking the question is, what did we have in mind? What did we want to get out of all the changes that we're actually seeking to put through on the financial regulation? And I'm going to give you some illustration on how it's impacting non-financial corporates, so the range of things that have happened and how it's having an impact on cash. So bank failure we've had post-financial crisis. Well, that means corporates want to diversify risk even more. Well, they use money market funds to do precisely that. They've had reduced bank lending. Fewer banks have been keen to lend. So corporates think, when I can borrow some money, I better borrow more than I need at this moment in time to have a bit of rainy day money, because those people that are going to lend me the money aren't going to be there. I need to diversify my lending risk. So I want to borrow from more people because I can't just rely on one. In fact, even now, we're starting to worry about the whole concept of when someone gives you a committed loan. Now, I've been a corporate treasurer for over 25 years. A committed loan means they turn up with the money as long as you comply with the rules underneath the document. We're now starting to hear that banks are more concerned about their regulators than they are about the documentation and the commitment under the loan. So if a regulator says to them, no, you can't do that anymore, they will break a committed loan facility. Now, what does that mean for a non-financial corporate? Suddenly, the non-financial corporate's not going to meet their liabilities as they fall due. Question, are they going to have the cash to be able to do that? So this is a worry. So they put a bit more cash aside to make sure that they've got it. There's more economic, political, and regulatory uncertainty today. Better put a bit more rainy day money aside, just in case someone changes the rules on us. That's what's happening. The other thing that's happening is people are sitting on their hands. I don't want to invest in that long-term project because I'm not quite sure the political and regulatory environment that I'll actually bring that project to bear in. So perhaps I won't do those investments that I thought about doing. Quantitative easing. Money's being pumped into the system. Lower interest rates, historically, we haven't seen them since God was a boy at this level. I was a treasurer 25 years ago. The maximum was, if it's below 10%, fill your boots. Borrow as much as you can for as long as you can, because you'll never see these rates again. We're at very low levels now. That's what we're doing. We're borrowing more than we need. The markets are open at a certain time. We'll take more than we need, and the bit that we don't need today, we'll put aside. So public policy is having an impact there. Bank liquidity ratios are coming into play. As a result of that, banks, people that we thought we used to give our money to, don't want our money anymore. So this money that we're actually putting on a rainy day side, suddenly we've got nowhere to put it. Oh, then there's the bank ring fencing that's coming in. We're not quite sure which part of the bank we're actually putting that money in and whether it's going to be there and accessible to us. And that other product I'm going to use with that bank may have a different risk on it, that I was using that deposit that I had to sort of even up the risk. But I'm not sure in the future whether it's going to be in the same place. Oh, and then you may well get bailed in. Well, that money that you had there may well get dragged in. So you're going to start to think about, I must take collateral. I must have secured deposits. That's what's actually happening. Corporates are getting concerned about that, and they're building up this cash. But they're also starting to be more active in sweeping their money. The whole concept of hard euro and soft euro is coming into bear. People are getting much quicker, much faster. Things are moving much quicker. SEPA is going to accelerate people actually doing their cash sweeps. There are more corporates talking about intraday activity and liquidity. More people are asking for intraday balances now. They're more concerned about it. So I suppose my challenge for the panel and everyone else that's in public policy at this point in time is if corporates just need that cash there to meet their liabilities they fall due, where are they going to put it? Banks don't want it. Money market funds, who knows what's going to come out of this debate? It could go horribly wrong. Where's it all going to go? Corporates will think about security first. They want to run their business. So I think there's a worry for us at this point. We're also already starting to see impact over critical period ends. Over the year end, we now start worrying about, will someone take our money? Well, the last year end that we've just had, you'd be pleased to hear it managed to work perfectly okay. Who took the money? US regional banks and Asian banks. Is that what we had in mind? Does that give us confidence that it's going to be there when we need it? So I think there's a bit of a challenge here. And I hope public policy makers can do their best to help solve that problem for us. Because if we don't, corporate money will be off.